And now it says that I'm live. I should have known that nobody was saying anything in there. I was probably just talking for the last 40 minutes and nobody was hearing me. Something updated with Streamlabs and it did not update. It did not update on here. Oh my goodness. Alright, I hope all of that got recorded. I'm going to have to go through all this again. How's it going, everybody? Welcome to Oregon Cash Flow Pro. My name is James Barber. I'm here to help you maximize your cash flow. I have been talking for the last 40 minutes, wondering why there's no viewers, nobody interacting. I just figured it was a slow night, and I was just going through a whole bunch of stuff that I had lined up. And it turns out it probably was not even recording it. At BDN, you were talking to the wall. I appreciate that. Because I was doing the same thing, so I can appreciate that. Normally, I hit go live on my Streamlabs, and it goes live in YouTube. But it didn't do that today for some reason. So, thank you for hanging around and waiting for this to actually start. I decided to go and check because nobody had been commenting. But I've been sitting here talking and talking and talking. Too funny. I had a really good one going too. I was going over an article. I went through a couple of questions that people had asked. I feel silly now. That was kind of frustrating. All the meanwhile, my food was getting cold. Has gotten cold because I was busy talking away. So how are you guys doing tonight? Do you have any questions I can answer? I'm about all talked out, talking to myself. Now we have a few viewers. Who's out there? Who's out there tonight? I was hoping to show you guys something that I stumbled across. I ended up this last week. Well, no, not this last. Was it this last week? The week before, on the 18th. Stock market same as March. Yeah, it's a rough one today. On the 18th, the day before my birthday, decided to buy a Model Y, Tesla Model Y. And we went up and did a test drive on it on Saturday, this last Saturday. So family loved it. Just found out that it's going to be delivered this Saturday. So we're going to be able to pick it up this Saturday. And so I was looking around. On Tesla's website. And it just so happens I also have a Cybertruck on order. But that's not going to be available until probably late 2021, maybe 2022. Depends on how quickly they get to mine. But they have a Cybertruck t-shirt on the website, on Tesla's website. And so let me show you what that looks like. This is the back of the shirt. Pretty cool. Got the little Cybertruck logo along with the top half of the Cybertruck. Pretty nice. But what got me, what I thought was hilarious, was the front of the shirt. And the front of the shirt looks like this. And they call this shirt on their website Bulletproof Cybertruck Tee. Now, if anybody watched the presentation when they announced the Cybertruck, they announced it as being bulletproof and having armor glass, which is supposed to be a bulletproof glass as well. And they threw a couple of steel balls, or they threw one steel ball a few times at the windows, and they were expecting to see it bounce off because that's what happened in practice. But what actually happened was it cracked the window. So this is like what we're seeing right here on the t-shirt. So it's great that Tesla can kind of laugh at themselves and use this for a marketing purpose. Like, I would totally get this shirt. It's got that indentation from the ball that cracked the window. Daniel, possibly, but not that low. No. Oh yeah, for the stock market being the same. Yep. It's not that low yet. Hopefully it won't get that low. Not really a reason for it to get that low at this point still. I think we're just seeing a lot of uncertainty due to the election coming up. Kyle, how's it going? How's it going? So you guys are a little bit late. I've been talking for 40 minutes already. It just so happens that Streamlabs didn't connect me to YouTube, so I was talking to myself for 40 minutes before I realized it wasn't just that nobody was here watching. YouTube never started my stream. So pretty funny. Workhorse and Space are down. Yep, a lot of things are down. Tesla was down today too. Daniel, notice on red days you seem to sell and buy. Yep. Kyle, natural gas might be a nice swing with everyone in home during the winter. Daniel, your portfolio now 71% Amazon. Oh wow. Did Amazon that's a lot in Amazon. Doing good. Doing good. I'm doing good. Hopefully Amazon does good. I imagine if a lot of things do tank, if there's future lockdowns or whatever, Amazon does benefit from that. So could be a good position to be in. It's an expensive position to be in, though. Definitely an expensive position to be in. Yep, quarter earnings coming up. Tomorrow, right? Tomorrow. Gotta hope they're positive. Always a lot of uncertainty around earnings. So gotta be careful. So, one of the things I was going over before I decided to check and make sure that I was actually live streaming was I was talking about an blog post about top class action lawsuits. Well, the website's top class actions, but it has to do with IULs, Index Universal Life Policy, false marketing, class action lawsuit investigation. So if you guys don't have, I'll keep up the questions in here, but otherwise I'll go through that because I think there's a lot of good information on here that people need to know about. Kyle, starting to like the pot stocks like Curaleaf, Trulieve, and Green Thumb. Daniel. But yeah, it's not bad. Average of 32.45 at 1.5 shares. Full portfolio 7.1K. Okay, cool. That's not bad at all. Not bad at all. Kyle, also data companies like DDOG, Fastly, Net, and CLDR. All right. Let's see. So I want to talk a little bit about this blog post. So this blog post is at topclassactions.com, and it's titled Index Universal Life Policy, False Marketing, Class Action Lawsuit Investigation. Banks suspected of IUL bad marketing practices. Who's affected? It says, have you purchased an Index Universal Life Policy and are not receiving the returns or account value increases that were shown to you in marketing materials or sales illustrations? Almost anybody that owns an IUL, actually I would venture to say everybody who owns an IUL, could answer yes to this, because illustrations are guesses. They're total guesses about what the future could look like based on a particular index earning a specific rate of return. And it assumes that they're going to make that same exact return every single year, which never happens. So the odds of the illustration not matching the actual returns, probably 100%. So I think this question is basically designed to get everybody to say, yes, I qualify for that. Let me find out more. And so you get into this a little bit further. Let's see. Daniel says down 280 on full portfolio, but you'll be positive when Amazon gives us the boost. Yeah, there you go. Carlos, good evening. I need to contact you because I need to get a little more information on one of your policies that we're doing. So Look for that when I get done here. Okay, so this goes on. The article goes on. An indexed universal life insurance policy offers the flexibility of adjustable life insurance premiums at face value, yet also provides the insured an opportunity to increase its cash value, supposedly without having to take the risk of investing in securities such as stocks. Other than the word supposedly, I would agree with that paragraph. It's not supposedly, it does actually have the opportunity to increase its value without taking the risk of being invested in the securities. So no supposedly about it. A properly designed IUL has the advantage of being tax-free while its value builds over time. That's correct. It goes on. However, people who have purchased IUL insurance policies may have been misled into expecting unrealistic rates of return due to fabricated and false illustrations used in marketing literature and sales material. Some insurance companies suspected in partaking in false marketing practices include Pacific Life, Allianz, Lincoln Financial Group, Minnesota Life, among others. So notice that it says suspected of, and then it just throws out some insurance companies' names. Now it starts off with Pacific Life, who absolutely is a culprit in some of these claims. Their product has incredible amount of fees associated with it, and I'll go into that a little bit more here in a bit. But Pacific Life is the reason that we just had instituted a whole new set of regulations around how we can illustrate IULs. Not Allianz, not these other companies that I'm aware of. But you do need to watch out. It's not necessarily the insurance companies who are being misleading, but it's oftentimes the agents that are being misleading. And they can be misleading outright by basically saying false things, or by withholding information, by not giving enough information on the potential risks that these policies carry. So one thing to recognize is that this blog post is about a lawsuit investigation, not an actual lawsuit. They're still in the investigation stage. So they're trying to identify people who might want to pursue something based on this. So even listing these insurance companies on here, they're not making a claim that these insurance companies absolutely did do something wrong, but they're saying it's possible. Contact us if you think you might have been wronged. And I 100% agree with that. I think if anybody thinks that they've been wronged, if they've been misled with information, they should look into possible compensation for that. So that's also why I'm talking about this. I may disagree with some of the things that in how this is being portrayed, but for the most part, I don't have any problem with this at all. With this, when it comes to trying to identify people who might have been wronged, I think that as insurance agents, we need to hold ourselves to a high standard, and we need to make sure that we provide not only the benefits, but also the risks that are faced with any type of policy that we sell. So this goes on. It says, what can I do? If you have purchased an IUL policy from, but not only, the insurance companies listed above, you may be entitled to compensation by joining this indexed universal life insurance false marketing lawsuit investigation. Notice it does continue to call it just an investigation. So this is not a lawsuit. Law firms pay this website to send them leads. So this website puts this up trying to draw people in, get them to fill out the form, and then they sell the leads to the law firms who sponsored this post. So just keep that in mind. I don't want people reading this thinking, oh, there's a lawsuit out there right now. I imagine there are lawsuits. There's probably lawsuits that have been settled because there are agents that do wrong things out there. There are agents that don't give enough information. There are agents that undersell the risks or ignore them completely. So something to be aware of. It talks about what an indexed universal life policy is, and then it says a few companies that sell them, again listing those same companies. And then it says, why are IULs potentially misleading? In recent years, life insurance companies have begun selling index universal life insurance policies by using sales illustrations and marketing materials that show favorable growth in example policies' account values in future years. This is true. Insurance companies may be misrepresenting or exaggerating market growth in these projections by linking returns with the performance of a selected stock index like the S&P 500 or the Dow Jones Industrial Average. Now, just by linking returns to the S&P 500 or Dow Jones Industrial Average does not make these misrepresented claims or exaggerate their growth. Like, they actually, all the ones I'm aware of, actually show you the returns that the market did, that those particular indexes did, and how it would perform with their particular caps. I don't have any problem with that. I don't think that's misrepresenting or exaggerating at all. So I have a little bit of a problem with that paragraph. It goes on. Otherwise, they may also link IUL projections to lesser known indexes with no historical track record at all, created by the sponsoring companies using illustrations that depict generous future values through back-tested models based on hypothetical returns from unrepresentative prior periods. This I absolutely agree with, and I mentioned it in one of my other videos when I talked about choosing indexes, which indexes to choose. There are a lot of proprietary indexes that some insurance companies use. These are not indexes that you can just Google and see the value on any given day. That puts you at a knowledge disadvantage. You can't follow along and see how these companies are doing. Allianz does not offer any of those indexes. The indexes that Allianz offers, you can just Google them. They are real indexes. They do have a historical track record that we can measure up against and see how your policy would perform based on the limits and the caps that are there. So I don't have an issue. I don't think Allianz really applies. And in fact, I'd be surprised if any of those other companies applied to a lot of these claims other than Pacific Life. It goes on. Therefore, insurance companies may be deceiving potential consumers into purchasing IUL products by promoting the allure of unrealistic and improbable financial positives. With the recent stock market volatility, some IULs have generated zero returns over significant time periods, and in some cases, the account values have actually decreased due to policy charges that were not disclosed to the purchaser. Even if markets were to continue to rise when hidden costs and fees are factored in, an IUL may provide a significantly lower rate of return than if the customer simply invested in securities directly. Now, I do agree with that first paragraph that there could be some deception in there by promoting unrealistic and improbable financial positives. That can absolutely be the case. You take in Pacific Life's example, where they have those massive fees, up to 7.5% fees, just to participate in their indexes, and you don't have guaranteed bonuses. And if the stock market or the index you're tied to goes negative, sure, you have a 0% floor, but you still have that 7.5% in fees. So your account can absolutely go negative, even if it doesn't go negative because of the index going negative. So it's up to us as agents to make it clear that our clients understand how all of these things work. All of these policies have insurance costs each year. It's that underlying cost of insurance. So even if you get a zero return based on the index, you're still going to have the cost of insurance deducted also. It's usually, if it's properly designed policy, those costs can be very small. But if it's not a properly designed policy, those costs can be big. And then also you have those insurance companies that offer the much greater potential of risk by making you pay those extra fees up to 7.5% from what I've seen. So definitely want to be aware of that. And it's on the agents to disclose all of this stuff. And people need to understand the risks. So yes, even if markets were to continue to rise, I have a problem with this paragraph. There are not really hidden costs and fees when it comes to IULs. As far as I'm aware, the regulations around these have been pretty transparent for a while. And while they're disclosed, they're not often talked about by the agents. So they may just skim over them. Or I've had clients who have specifically asked other agents about these possibilities, and they just brush them off and say, "Oh, don't worry about it." The risks could be not just costs and fees, but also what's the potential that the cap rates might get lowered? What's the potential for the participation rate to get lowered? Now, the contracts themselves disclose all of this stuff, but not everybody reads those contracts. They're very difficult. They're thick. There's a ton of words, and it's very technical, and it's easy to get lost in it. So I don't blame folks for not reading through those with a fine-tooth comb. It's up to us, the agents, to make sure that they know these things. And if the agent is not disclosing all this stuff, I have no issues with somebody trying to sign on to one of these investigations and see if you can get some compensation. But I just wanted folks to be aware, because I had some people talk to me about it. This was sent to me by a client who had just signed up for an Allianz policy, and while he wasn't really concerned, he did wonder about this blog post. So, has an IUL lawsuit been filed? One class action was filed against Life of the Southwest in California. I don't even know that company, alleging that the company's IUL products violate various California consumer fraud statutes. Another class action was recently filed against Pacific Life on behalf of policy owners who purchased the Pacific Discovery Accelerator IUL, likewise alleging violations of the California consumer fraud statutes. Yeah, so those I knew about the Pacific Life because that one's not a good product, in my opinion. But the other one I hadn't heard about. But notice that they don't mention Allianz, Minnesota Life, or the other one that they had mentioned. So, Lincoln Financial Group. They don't mention those specifically. So, but they do throw out that you could participate in this lawsuit potentially. So get in touch with them. If you're interested, if you've been wronged by an agent, get in touch with them. Find out. It probably doesn't cost you anything, although you may get bombarded with some calls from some attorneys, but that's just part of what you got to deal with if you want somebody to represent you. So anyways, I wanted to go over that with you folks. Know that this is out there. I wanted to address it head on, and really each specific claim, most of it I agree with. There are companies and there are agents that you got to watch out for. So hopefully that helps you guys become better consumers of insurance products. Daniel, you got to go. Study for your accounting 2 class tomorrow. See you in the morning. All right. Have a good night, man. Have a good night. Carlos, once you get a loan from life insurance, how you create the payment plan and how often you make payments to the insurance company. Do they send you a statement? Good questions. So when you get a loan from your life insurance company, there is no payment plan. You actually don't have to pay that loan back on any set time period or at all. They know that if you pass away, the death benefit will pay off the loan. That does not mean you should ignore the loan. So, how a payment plan gets created, it's up to you. You have to create your own payment plan. Come up with a plan, and we recommend just like a bank would do. Make a plan for yourself just like a bank would do. Pay that loan back, knowing that every payment you make on that cash value is again available for you to borrow out. So you don't have to worry about like your typical loan where you put money into it, and then if you want to get money back out, you've got to requalify for something. Or when you put it in, now it's locked up in equity that's not liquid. Not the case. You create your own payment plan. You can make payments as often or as little as you want to the insurance company. They do send you a statement, however. They'll send you a statement once right after you get the loan, and it'll tell you what you borrowed. And then you'll get a statement each year on your anniversary, and it'll tell you how much your loan is outstanding. And it'll say, make a payment on your loan. Although you're not required to make a payment, they will make a suggestion. You can promptly ignore that if you want to, or you can make a payment. Totally up to you. My suggestion is cover the interest cost. If you cover the interest cost of any of your life insurance loans each year, the underlying value of your account will continue to grow and compound, and the loan interest will not compound. So we'll always see some separation in growth as this compounds and this doesn't. So it's the best way to keep that policy growing forever. Kyle, if election is contested, SPY goes to 300. If it's a landslide, SPY goes to 335, as we will be closer to stimulus if not contested. This may be the highest volatile moment we've ever seen. Be ready, folks. Can't argue with you there. If election is contested, buy SPY puts. If landslide, buy SPY calls, Kyle suggested. All right, that could be good advice. I can't say one way or the other because I can't tell people how they should invest. I'm not licensed to do that. Shashay, your information was helping you to know the right choices to the IUL. Thank you. You're welcome. I'm glad to have helped. It is my goal to provide as much value to you folks as I possibly can. And if I get a chance to write some insurance policies along the way, even better for me. And in my opinion, better for you too, because I know I designed these policies with your best interest in mind. So, BDN, elections results will impact the stock market. Yes, I think that was supposed to be impact. Elections results will impact the stock market. For sure. The whole election is already impacting the stock market. Yeah, Kyle. So I really can't advise people on what to do or what not to do, but I can tell you what I would do. I don't have the money in there to buy the puts or calls on SPY. That's not part of my trading strategy. So anybody interested in my trading strategy has got to join our cash flow mastermind group in the Discord. And to do that, you just become a Patreon. And one of these days here soon, I'm going to make a thank you list of our Patreon, and it'll run on each video because I do really appreciate everybody who's become a Patreon member. It provides me with a little tiny bit of a recurring income, which is nice, but it helps offset a lot of my time that I spend doing these videos and doing the live streams. So I really appreciate it. It helps me get out more content for everybody to get the most value out of. So definitely is a help, and I love my patrons. So I know I don't say that enough because I'm kind of new to even having any patrons, and I don't know exactly. I don't know. I don't know. It's kind of like it's not in my nature to like constantly talk about things like that and try to get more people to join. And I just don't like to be like a salesman in that regard, right? I try to provide a lot of value, and I'm hoping that the value I am providing in there is going to keep it growing. I'm also coming up with memberships, YouTube memberships. So you don't have to join the Patreon. You can get access to the Discord server by just becoming a member here. But I haven't quite finished that up yet. Something I need to be working on this week. Carlos, Kyle, really wishing you sold Apple calls at 125. Now back to 105 we go. Yep. For sure. Carlos, once you start making payments, you can make maybe 15 to 20% interest, 5% to cover insurance charge, 10 to 15 for yourself so your money can grow. Is that possible? Yes, it sort of is. You're not technically paying yourself a higher percent interest rate because you're making payments. Those go back to the insurance company. The interest goes to the insurance company. What that does is it releases the collateral in your policy. So if you're paying extra, if you're paying an extra percentage, that's just going to release your collateral quicker. You're going to pay it back quicker. Now you could, and the way a lot of people out there pitch this type of infinite banking policy and infinite banking concept is, you're paying yourself extra. It's not really paying yourself extra unless you're putting that in as new premiums. So you can, if you're not already hitting your MEC limit each year, you can use that to psychologically give yourself an edge to put more money in than you might otherwise want to put in as new premiums. Otherwise, you're just paying down the loan a little faster. So you don't have to, however you decide to pay back the loans, it's totally up to you. But you really can't pay yourself more interest technically. It's just paying down the loan quicker or it's new premiums that you're putting into the policy. Kyle, I don't understand why stimulus helps the market so much. How does 1200 help people? 1200 is nothing. 1200 is nothing to you, but there is a lot of people that basically are on the verge of eviction. They don't have, they're not living at home with their parents. Even minimum wage doesn't cover rent in almost every market in the United States. So for one person to be able to live in a single family apartment. So $1,200 can make a big difference. Can make a big difference. Even if somebody is short a couple $100 a month, that $1,200 could get them by for 6 months without continuing to go behind. Not only that, but the stimulus helps the market so much because that $1,200 goes into people's hands and they spend it. And they spend it at businesses. And those businesses need that income in order to show profit. And that profit translates into higher value in the stock market. So that's why it makes such a big difference. Without that, if a lot of people stop spending, our whole system falls apart. Our whole system is reliant on people consuming. And when people can't consume, our system crashes. That's what happened back in March. Nobody was going out to businesses. All the restaurants were basically empty because we had a failed response to the coronavirus. And suddenly we had this blow up of cases and everything needed to be shut down in order to slow it down. That's just the situation we were facing. So that hurt a lot of small businesses. Didn't impact the markets because the markets are not made up of all those small businesses that went out of business. The markets are mostly larger companies. So larger companies were impacted less because that first stimulus gave almost all of that money to those larger companies. So of course they're able to hold on and keep performing. Another thing that happened was apparently they passed some rule that allowed companies to generate a balance statement that would essentially ignore that second quarter drop as if the coronavirus didn't happen and as if the lockdowns didn't happen and they didn't actually lose sales. They were able to present based on what they would have sold had they been allowed to stay open. It was a really shifty way of allowing that type of accounting to be used to keep stocks propped up, but that's what they did. So Kyle was just thinking that because $1,200 can't even pay most people's rent for 1 month. So what about all their other bills? But you guess every dollar helps. Yeah, it helps. That's it. I mean, $1,200 wasn't enough. It wasn't enough back in March. If you look at Canada, they gave $2,000 a month, every month, while their citizens are trying to get through this. That actually allows their citizens to quarantine like they needed to, or stay outside of the workforce if they needed to. Our system, meanwhile, forced people to get back out there and go back to work before it was necessarily ready. I'll tell you, I've been thinking about this. How I would have approached this is I would have said, okay, if we do a 2-week lockdown, a 2-week lockdown is long enough for people that were infected to be able to be identified. They would be able to know if they were sick or not. So if we can do a 2-week lockdown, we can identify the sick folks and isolate them, get them quarantined, and not have them be exposed to other people. You do that by offering, $3,000, $4,000 per person? Just give everybody $4,000 to stay home for 2 weeks. That should cover everybody. It gives people the ability to stay locked down. And then I wouldn't do the whole country all at once. I would do it in a rolling shift. I would probably do East Coast, Central. I'd probably shift it, make it, maybe you do 4. Maybe you do 4 sections of the country. But you let them know a month ahead of time. You say, okay, we're going to be locking down in a month. So get all the supplies that you need so you can handle 2 weeks at home. For those, and this is why we spread it out. You don't do the whole country all at once because then you're going to have everybody trying to purchase the same supplies all at once. You roll it out starting on one part of the country, and you can divert supplies to that part of the country first so that they can get what they need and not run out. And then you do the next part, and then you do the next part, and then you do the last part. And you lock down the first part of the country for 2 weeks. Nobody, you have the National Guard man that whole length of the border and just make sure people know they can go into the areas that haven't locked down yet, but they can't come back. They can't come back until that area that they've gone into has gone through its lockdown. So you can go one direction, can't come back, except for we got to have goods and services that still come through. So we would have people on the border that are checking the trucks. Next section gets locked down. The first part comes out of lockdown, but they still can't travel into the lockdown section. Now we're in this section, and people can continue to go to the west, but they can't come back. That part gets done. We lock down the next one, and so on. And then soon the whole country's opened up at that point. So once this lockdown is over, now these two sides can travel freely. Once this lockdown's up, now all three of those can travel freely. So that's what I would have done, and we probably would have been able to stop this pretty dang quick. Because you go 2 weeks, and this thing can't multiply. Would have been a heck of a lot better than the 200,000 people plus that have died so far because of the terrible response that this country has had to it. So, my opinion on that situation. Kyle, holy smokes, go to Canada. How did Canada afford that? Just so you know, we can afford that. Governments can't afford that. Governments are allowed to create deficits. That's like the reason you're allowed to create deficits, so that you can meet emergency needs. We have more than enough money to do that. But our politicians like to pretend that we don't. And like they just can't do it. The reality is they don't want to do it. And why they don't want to do it, I have no idea. But they care about something else a hell of a lot more than they care about all of the people getting infected with a deadly disease. So, BDN, Corona is smarter than the human. Possibly. Well, I don't know about smarter, but it might be able to outmaneuver. Outmaneuver some efforts, that's for sure. All right, where are we at here on time? I went through that class action lawsuit. We are now at, I don't even know how much. What time is it? 7:16. We're going on 40 minutes. That's pretty good. All right, let me go back to Moldy Boats. Canada can afford it because you had to buy cans of chewing tobacco there for 2 weeks last summer. Too funny. Too funny. So next question somebody had. Whole life or IUL? Which one would you recommend for a person in their early 20s? My response was most likely a properly designed IUL. But I would like to know the overall financial situation and goals of the person before I say that for sure. But I do like IULs for young people as opposed to whole life. And the reason is an IUL has that underlying cost of insurance is annual renewable term insurance. It's very inexpensive. And so a young person typically can't afford tens of thousands of dollars a year in premiums. So we can design policies at just a few $100s a month, even as little as $100 a month, with an IUL that can generate an enormous amount of cash value over the life of the policy, even if they only ever put $100 or $200 or $300 a month into that type of a policy. Now, obviously, as we went over earlier, there are some risks involved with an IUL, more so than with a whole life. A whole life gives you guaranteed growth and a guaranteed death benefit. An IUL gives you a 0% guarantee on growth. You can't go negative in regards to the index, but you still have insurance costs, okay? But it has a much greater growth potential than a whole life policy. Much greater growth potential. And when we're talking young folks, preteens, teens, 20s, those folks have 30, 40, 50, 60 years of low-cost insurance before they have to worry about that growing cost of the annual renewable term. And so while that cost is really low, they can take advantage of the growth in the stock market, and they can go through the ups and the downs and get that compounding. So that's why I recommend the IULs for kids and for young folks, is you get that long ramp-up period where you can take advantage of that much greater growth potential. And if for some reason it doesn't perform, we can get you out of it. We can do a 1035 exchange, put you into a whole life policy if we need to, something that you might be more happy with at that point. But if the index is performing, much better off to have that growth potential in the IUL. And of course, it has to be properly designed. So one of the ways that we design it, we minimize agent's commission, we minimize the death benefit, and we maximize the ability to fund that policy. So Moldy Boat said $35 per tin for that chewing tobacco. Holy moly. Holy moly. Whacker, hey James, what is your strategy? What's your investment strategy for time period of coming weeks? My strategy is not going to change from what it was for the last couple weeks. And I put that strategy in a video and I shared it with my mastermind group on the Discord. So if you want to know what that is, if you want access to that, you got to join the Discord and you got to join that mastermind group in the Discord. It costs $50 a month, but it's going to be well worth it. It's going to be well worth it. I'm going to provide way more than $50 a month in value for joining that. If you're investing and you want to figure it out. Over the last month, not even the full month yet. I'm up about $4,000 with this strategy, and I don't expect that to change. In the coming months, regardless of what the stock market does. But I am leaving that strategy just for my mastermind group. I got to hold something back for them because I am trying to provide some value that not everybody has access to. So, and that group, a cash flow mastermind group in particular, is a group of folks who are dedicated to helping us achieve financial success. So we're sharing tips, we're sharing ideas, we're talking about different strategies, we're talking about tax strategies, we're talking about investing strategies, real estate, anything that we can find value in, it should be shared inside that mastermind group. And so that's what I'm trying to do. So please join us if you're interested, and if you have an interest in sharing how you plan on having success in the coming weeks as well. Would love to get some more input. Carlos, can they have both young people, Allianz, and Guardian for life insurance? Oh, sure. You can definitely have both. It's just young folks tend to not have the type of disposable income or the financial acumen to be able to fund multiple policies like that. So usually the question comes down to which one. I would absolutely do both, though. I wouldn't have any issues designing a strategy that utilizes both. Whacker, is $50 a one-time fee or every month? It's every month, but if you do it, if you don't get value out of it, you can always just leave. So if you join it for the one-time $50, you can watch the video and you can catch up on all the stuff we've been talking about. So, and then you're welcome to go. My hope is that you won't. My hope is that you'll join and you'll stay and you'll easily find $50 worth of value so that you can stick around. Because I think the value is going to come over time as well. The massive value is going to come over time. Not only as we learn from the different strategies that we're employing, but as we share those. So it's going to take time. Not everybody's going to get into the group and just dump all of their knowledge so that you can take advantage of it in 1 month. We're going to have to pull that out of people. And my goal is to start having some mastermind meetups inside that group where we can explore specific topics. So if a specific topic interests you, it can be addressed at a meeting that you can attend. So virtually, of course. But things like stock market, dynamic banking, infinite banking, options trading, real estate, tax strategies, growing a business. Yeah, all kinds of those things. So I have a poll at the top of that chat group where people can indicate where their interest is, and I'm going to be using the answers on that in order to set up the meetings that we'll have moving forward, where we'll be able to explore those topics and find out what type of information we can provide to help people in those. Let's see. Carlos, we as a parent will pay for the insurance and we can use it for investment or for whatever. And if so, what amount would you recommend so they can qualify? So your kids can qualify for half of the death benefit that you as a parent own. So if you own $2 million in death benefit, they can qualify for up to $1 million. And the death benefit that they qualify for will determine how big their policy can be, how much premium they can pay. $1 million on you might cost $30,000, $40,000 a year. $1 million on a kid might cost $5,000 a year, $6,000 a year. I mean, it's a heck of a lot less. So we can get up to those death benefit amounts really quickly when they're so young. So it does make it hard to put a large amount into a kid's policy, but it depends on how old the kids are. I mean, the older your kids are, the easier it is. One thing to keep in mind is that insurance companies do like to see the same amount of coverage for all of your kids. So if you just apply for one of your kids and you try and get a huge policy on one of them, they may come back with some questions, wondering what's the plan here? Why is there not equal amounts of insurance coverage on all the kids? And does the parent have coverage? So a lot of questions that can come up. Carlos, it's not worth it. What's not worth it? What's not worth it? Having coverage on every kid? Is that the concern? Not sure what you're saying isn't worth it in this regard, because I talked about a lot of stuff. We'll see if there's a response forthcoming. Not sure how much delay we're working with. You want to create a large insurance. Oh, not worth it because it's hard to do if you just fund it at a small amount for the kids. It can be worth it. It just depends on how early you get started. So like for my kids, I have a policy designed at $3,000 a year. Not a large amount, but starting when they're young, they have the ability that if they keep contributing to it when I'm gone, that $3,000 a year could turn into potentially $100,000 or $150,000 a year that they could potentially pull out every single year in retirement. So it can build up. You just got to give it time to work. Such a small amount does not do the job for investments. Yeah, not starting out where you would like to start out at. It does make it difficult. You're right. So it's not like you can take a kid's policy, fund it at a couple of $1,000 a year, and have enough in 10 years to purchase rental real estate. You definitely don't have the ability to put that much into it. But that's why you got to start early. So the sooner you start, the better. On yourself, for sure, because the more insurance you have, the more insurance they can qualify for. And then the more insurance that they qualify for when they're young, well, those policies grow as they get older. So when they want to insure their kids, they're going to insure their kids at an even larger amount, because that's how this thing just keeps going. So you're basically starting a legacy gift that can roll from generation to generation to generation, and it can continue to grow every single time. But you got to get it started. That's the important thing. Mosh, how's it going? How are you doing? So it is 7:29. Now it's been 50 minutes. We've got a little bit more time on here. As long as you guys have questions, I'll keep going, because I enjoy doing this. But I do need to contact one of you guys after this so we can talk about what the underwriter just sent me. So I can't go too much longer. But if you guys got any questions, throw them out there. Anything having to do with finance, we'll do our best to answer them, providing you guys with some value. Let me look and see what other questions we got here. Let's see. Francis, how's it going? How do you calculate the real cost of a loan against your cash value, knowing you're also earning interest on your cash value? Oh, that's a good question. You're not going to be able to calculate it until after the fact. You can make a guess, but the challenge comes with not knowing what the actual cost of the underlying insurance is going to be until after it gets charged. So take whole life into consideration. We have a policy that you can borrow at 6% interest, and you get a credit of 6% interest. Well, you don't actually get a credit of 6% interest. That's the gross amount. You have insurance expenses that get deducted from that, just like if you were going to get a dividend, a 6% dividend. You don't actually see 6% return. You see whatever the costs are after the insurance expenses. And then there's some other factors involved, but insurance companies don't credit every single policy the same when it comes to the dividend rate. So their announced dividend rate is X amount, but any particular age group may get a certain percentage of that. And it's up to them to split it up so that each of the policies end up performing to the guarantees, to at least the guarantees that they offer. So if you have if you have $1 million life insurance policy and you put $10,000 a year into that policy, it's going to start out and they're going to say, okay, these are the projections that we're going to make. $10,000 a year goes into the policy in the early years, and it has to compound at a certain rate in order to meet that $1 million death benefit by X age, by age 95 or by age 100. And so they're going to count on that happening. Dividend rates vary throughout the years, and so they're going to have to adjust it so that stays on target. That has to stay on target. So how they divvy it up may vary among the actual insureds. So something to keep in mind. All the rates that we hear being announced, the dividend rates and such, those don't tell you the actual amount. Those are just the gross numbers. The net numbers, we don't know until after you get credited for that. So something to be aware of. So I would figure it out after you're done. After you're done, or at your policy anniversary, you can look at what the loan is. You can look and see what you got credited based on that loan amount. Now that's assuming you have a direct recognition loan. A non-direct recognition loan, it won't matter what the rate is that you're borrowing from. That will not affect the growth in the policy. So in that case, then you're going to have to see what the dividend rate is and how much you ended up netting there. So you'll still have to wait till the end of the year so that you can get your statement and do those calculations. Does that make sense? Mosh, never been on a session like this. What's this about? This is a Wealth Care Wednesday live stream. It is about finance. So my goal is to answer your finance questions, help you maximize your cash flow, identify any financial needs, or if you have financial questions. So we talk about cash flow, infinite banking, dynamic banking, life insurance, real estate, business advice, whatever you have questions for, I will do my best to answer and provide you with some value so that you can be in a better financial position than when we started. Moldy Boats, James, lending against my Schwab investments is at 6%. You also have a PLC that is 12%. Which one to use for dynamic banking is best? Seems obvious, but maybe not. What's the PLC? You have a PLC. What is a PLC? Personal line of credit? PLOC? Is that what that means? Personal line of credit? A couple of things that I would weigh is your personal line of credit at a zero balance? Or do you already have some borrowed out from it? Also, when you borrow against your Schwab investments, do you have to actually take money out of your investments? Or is it just like using margin, where if markets drop, they could do a margin call and require you to pay that loan back before you anticipated paying it back? So those are questions that definitely would need answered before I can make a determination. I would not want to use your investment account if you were at risk of them doing a margin call because of it. However, if it works just like a line of credit and it doesn't affect your underlying investments, you don't have to touch them, I would absolutely do that one first. You get a better loan rate, and I would assume that you can have it work just like the other line of credit. Personal line of credit is at 80%. Okay, so you already have the vehicle that you should be addressing then. You should be doing it in the personal line of credit. Because when we do dynamic banking, we're offsetting interest charges. Now, if you have the ability to borrow from your Schwab account at 6% and pay down that personal line of credit, I would do that first. And then I would use your Schwab account. Okay, no, it's basically a margin loan, but all right, I'm going to have to wait and see what your but says. BDN Ltd in UK PLC. I don't know what that means. I don't think Moldy Boats is in the UK. 60% maintenance. That still puts you at risk. So I would probably not use the investment account, because what happens if the same thing that happened back in March happens? You're going to get a margin call possibly at the worst possible time, because you actually might need money and it's not going to be available to you, or you're going to have to pay it back, or you're going to have to sell your stocks at a discount, sometimes a massive discount, in order to meet those margin loans. So I probably wouldn't use that. You can do dynamic banking with a 12% line of credit and do just fine. Just depends on what you're doing with it and how you practice that. So check out the video Beat the Bank and Dynamic Banking in Action, and you'll be able to figure out how to make that work for you. Francis, follow-up. So you only borrow against your cash value if the interest rate is very competitive, the lowest compared to the other financing options. Sort of. What I say is you only borrow against your cash value if you need it. There really isn't any limitations to it. I do try to find the best interest rates, but that's not always the determining factor. You may decide to borrow from your policy because you don't want to have a credit inquiry on your credit. You may decide to borrow from your policy because you can't qualify for another loan. You may decide to borrow from your policy because it has the best interest rate. You may decide to borrow from a bank because it offers a better interest rate or more flexibility. It'd be hard to provide more flexibility, but you may decide to borrow from your policy because you don't want to have set payments that you have to stick to. There's all kinds of reasons why you would borrow from your policy, even if it's not the lowest interest rate. So things to consider. Mosh, what would you invest most of your money in with 1K a week cash flow? I would put that first into my life insurance policies. I would do a whole life policy if I didn't have one already, and I would do an IUL if I wanted higher potential growth, or if I was a young person. I believe you're really young, so in your case, I'd probably look at putting it into an IUL first. Now, once it's in the IUL, you have the potential growth that you can get from a leading index, and you have access to those funds. So you can put the money in there, and then you could borrow against it to do other investments. So if you wanted to then invest in Tesla, I would do something like that. In fact, I did do something like that. The money that you see in my account every day when we're trading, that's money that I borrowed out of my life insurance policies. And I did that because I can make a much, much higher return with the strategy that I'm employing now. Now, I originally did it learning, figuring I would learn a strategy. And I did. It cost me. I definitely lost quite a bit of money while I was trying to learn which strategy to go with. Now that I figured out which strategy I'm going with, the returns are incredible, and I'm going to be able to pay back those loans without much difficulty. And I have no qualms keeping the money out and invested in the market because of that. So I'll probably be pulling a little bit back here and there to pay those loans back. But it gives me peace of mind that, one, I have a death benefit sitting there that's going to take care of my family even if all my financial goals aren't realized before I pass away. And two, it's protected from the stock market. So I have growth that's protected from the stock market. It allows me to invest aggressively and know that I'm not putting everything at risk. PLC means public limited company. LTD means private limited company. Oh, right. Yeah, for the UK. Moldy Boats isn't UK, though. I think he was talking about a personal line of credit. But thank you for explaining that. Moldy Boat said the plan was for 2020 not to happen. Yeah, I get that. But you know what? It happens every 10 years or so. So 2008, a recession, a drop, a correction, whatever you want to call it, happens all the time. So you don't want it to happen while you got loans out and they make a call on that. It's up to you what you want to risk. Now, let's look at it this way. If that personal line of credit has enough available in it for you to make up a margin call, then you're covered. As long as you have money from somewhere that you can put into it. So if you want to, you're Arizona. If you want to have a specific discussion about your plan, you can always sign up. Sign up for one of my meetings, calendly.com/cashflowpro, and we can go over specifics. I can definitely make some recommendations there. There's a 20-minute free consult offer there. Anybody can use. And you guys have been keeping me really, really busy with that too, by the way. It's been great. BDN, the difference is that the PLC can quote the shares in a stock exchange, whereas the LTD company cannot. The shares can be bought and sold through the stock exchange in a public limited company. Gotcha. Mosh, how does it grow? The IUL grows based on whatever index option you choose. So the policy that I like is Allianz, and the index options that they offer that I like is they have a Bloomberg volatility index that they give you a credit. Whatever the index grows at, they give you a 145% participation rate. And then they also offer a bonus on top of that. So in 1 year, we'll say 2017 in particular, because it was like the highest growth year of the last 15 years that this index has been in effect. 2017, the index itself returned 14%. Yeah, 14%. You multiply that times the 145% participation rate. That gets us up to a 21% growth that they credit your policy, but that doesn't include the bonus yet. Multiply that by the 40% bonus, and you actually get a credit of right around 30% for that 1 year's worth of growth. So that's how it grows. It grows based on the index. Now, that was the breakout year. That was the biggest year that index has seen. The next year was a 0 year. There was no growth. The year after that, though, saw 12% growth, which translated into, after the participation rate and the bonus, translates into about 27% credit. So we had a 30% credit, 0%, and then 27%. Now, over the last 15 years, there was only 3 years that went negative. That one in between those 2 big years was one of those 3. For the most part, it tends to do, 8 to 10, 12, 14% after the bonuses. So really good index options that Allianz product offers. Moldy Boats, you can make up calls. You won't get caught like in March again. Okay, good. Mosh, I'm 20, just opened a Roth IRA. Good, love Roth IRAs. And investing smartly in Webull account, which consists of ARK Innovation ETFs, TQQQ, SPY, and Tesla. All right, that sounds pretty good. So you opened the Roth in Webull, and you're doing the trading yourself, I'm assuming. On Robinhood, you've lost a lot on options. More risky, but you know how it is. High risk, high reward. Haven't seen reward yet. Yeah, you got to do specific strategies with the options. You should definitely consider joining. The mastermind group. I think there's a lot of value to be had from young folks. The sooner you get started in that, the better off you're going to be in the long run. Much better off. What everybody needs to do, and the reason I created this mastermind, is you surround yourself with other successful people who are pursuing similar goals. And in this case, the goal of that group is financial success. So you always want to try and surround yourself with like-minded folks trying to achieve the same goals. That's how you up your game. And for young people, you especially want to surround yourself with people who have that experience as well. Because if you're just surrounded with other 20-year-olds, nobody has that life experience to speak from. Everything's theoretical still. So it definitely is an advantage to have a wide range of ages as well. Moldy Boats, you like life insurance, but you're no 20-year-old Adonis. Pretty sure you're going to croak in less than 5 years. Yeah, you may not have the ability to apply for life insurance in that case. So I would just focus on your dynamic banking and maximize your cash flow best you can. And keep playing in the stock market. Seems like you're fairly successful in that regard, at least from our interactions. It seems like you're doing okay. Mosh, yes, I should. Where can I join? What's that group about? You got to go to the Patreon. I will put the link in the comments, so give me a second. It is, let me see if I can. Okay. Patreon.com/Oregon Cash Flow Pro. So go to that, sign up for Tier 3. Tier 3 gets you into the mastermind group, and you can watch my video on my trading strategy. Might learn a thing or two, might help your Robinhood trading. But yeah, check it out. Hop in there, fill out the poll at the top that's pinned. Tell me what areas interest you, and we'll make a plan for addressing those areas. See if we can get our mastermind group together to have some productive conversations. Francis, on average, what is the difference in premium between IUL and whole life for kids? Ooh, that's a good question. I haven't figured out the exact difference, but to illustrate, when it comes to the cost of insurance, an IUL is based on annual renewable term, which starts off very, very low, and it grows over time. And it does a hyperbolic growth where it gets up, up, up. And then as you get older, it starts to really get higher. Whole life, on the other hand, is a level death benefit. So it's a level death benefit. How do they determine that level death benefit? Well, they take your assumed age, the anticipated mortality rate for you based on your demographics, and they're going to do annual renewable term. And they're going to see, okay, if this person lives till 80, annual renewable term will grow like this. And then it stops. And they're going to take that amount and they're going to average it for the whole time. And so what happens is you have an IUL that has an insurance cost that's about this much, and your whole life might cost, this much over the life of that whole life policy. Well, the IUL has the ability to grow with an index based on everything you put into it above the cost. So if the cost that you're putting into a policy is this much, the cost of the IUL insurance is this much, you've got a lot that turns into cash value. If the cost is whole life insurance and it's this much, now you've only got a little bit of cash value that's going to grow every single year. So it really limits the ability for that cash value to grow very quickly. So what we see when we illustrate for kids the potential growth down the road, it's decent in a whole life policy. It's not bad, but it's not as good as it possibly could be with the IUL. So, because of the potential in the IUL, I think it's well worth it to take that little bit of risk for those much, much greater rewards. Go with the IUL. Fund it at that smaller amount that still gets growth, so you're not risking as much. Whereas like with whole life, in order to get decent growth, you might have to put $20,000 a year in on a kid. You could probably get some similar type of cash growth by putting in $3,000 a year into an IUL, just because that underlying cost of insurance is so much less expensive. So something to consider. Now the actual results may vary when we do the illustrations. I'm not going off of an actual illustration that I have in my mind because I haven't done any recently that I can think of. In order to project out some of the growth. I've done IUL illustrations for kids, and I know what those look like, but I have not done an IUL illustration on a kid lately. At least not one that wasn't funded at $20,000 or more. So I had the last whole life the last whole life policies I did on kids. We were funding them at $20,000 a year for the kids. A substantial death benefit. You're talking $2 million death benefit on the kids. So it takes quite a bit of life insurance on the parents to be able to get to that point to begin with. So, yeah, you're welcome. You're welcome. Hope that helps. All right. Let's see. Hey, we're doing pretty good. We got 16 viewers and we got 8 likes. That's a pretty good percentage. If you haven't hit the like button yet, be sure to hit the like button. It tells YouTube that you're enjoying the content. They'll share this with more people, and hopefully other people will see that we can provide a lot of value, and they'll come join us the next time. Answer and ask some questions that may benefit everybody that gets to listen to it. Moldy, but to those who can get it. Had when I was young. Totally surprised when I cashed it out. Didn't pay the monthly for over 10 years. Saved your bacon a few times. Sorry you had to let it go. I hear you. But it does come in handy. More so while you're alive. You'd be surprised. People will be surprised how much they can utilize it while they're alive. It is not just for a death benefit. And that's why I almost always recommend some type of permanent life insurance that grows cash value. Because everybody has a need for it at some point in their lives. They just need to figure out how big of a policy does it need to be. And that's what varies greatly for each person. But I think everybody has a need that can be met by it. So, all right. Well, we've been going for over an hour now that I've actually turned on to YouTube. I've been going for almost 2 hours now by myself. Well, the first 40 minutes were by myself. So I can feel my voice getting tired. We're going to call it a night. I appreciate all of the questions. Feel free to join us next Wednesday. Come up with some more questions. If you want the opportunity to win a book or something off of our Teespring marketplace, like a shirt or a sweatshirt or a phone case or something, go to my website, OregonCashflowPro.com. The top post, you can click into there and leave me a question via voicemail. And if you leave me a question via voicemail and I use that question on this live stream, you win. You win a prize. So rather than me spinning the wheel, I would really love to get some questions left on our voice machine. It ends up working out better, and I can make more content with it. So I really want to encourage folks to use that. So if you do that, it's a really easy way. You don't have to win the spin the wheel. All you got to do is come up with a question that's good enough for me to put here on our live stream. So if you do that, you get to win. So I hope to hear from some of you guys. Let's see. We got a couple more comments. Mosh says, do you think my 10 Ford $8 calls give me a nice profit tomorrow? I don't even know where Ford is at. Ford has been... I haven't seen Ford over $8 for a while. So any reason to think that it's going to go over $8 tomorrow? Mosh, UPS killed me. Killed really. Hope the market... Oh. Killed me. Killed really. Not sure what that means. Hope the market goes green tomorrow for your Friday calls. Me too. Me too. I have some calls that I'm hoping will come back up. They're Tesla calls, of course. I bought some calls today thinking that we were hit the bottom and we were gonna go up. And boy, we just kept going down. I thought we were gonna have a power hour where we ended up for the day. That was a bad guess. So as usual, when I'm trying to trade options like that, just straight calls, if you pick the wrong direction, you're screwed. And I might have hurt myself quite a bit on that one. So hopefully we'll see some green and be able to make that up. Have a good night. We'll see you also. BDN, good night. Moldy Boats, huge earning beat for Ford. Oh, gotcha. Well, good luck. That could pay off then. I've been consumed with the live streams. I haven't had a chance to follow any of the earnings reports. So we'll cover it tomorrow, I'm sure. So we'll see you guys in the morning. We'll be back. I'm going to play you out with some music. And we'll see you soon. Let me figure out this one. Here we go. Play some good music on the way out. Good night.